Hi, my name is Steve Walker from Promise Money, and today I'm going to tell you a whistle-stop tour through what's going on in the commercial mortgage sector if you want to buy investment property. Now, timing is important here because Liz Truss has just gone, Rishi has just come in, and we've got all the turmoil in the market that's been caused by what's gone over in the last few weeks. So if you're watching this and you are in 2023, you might want to go back to our YouTube channel because there might be something more recent, or go back to our website. So that's promisemoney.co.uk. Check out, there might be something more recent. But right now, here's where we're at. So first of all, commercial investment property. Well, what are we talking about? We're talking about offices. We're talking about multi-let residential properties. We're talking about warehouses, factory. We're talking about development exits. What we're not talking about particularly, because lenders don't like them right now, are petrol stations, wet-led pubs, converted churches, places of worship. Those are really quite tricky. So those are a problem. But for most other areas, it's pretty good. Offices weren't great during COVID. Retail wasn't great, but it's coming back, so it's okay now. So it all comes down to the whole proposition, and our job is to get that proposition right and make it look as good as we can so we can get it into the best lenders. What I should tell you is that investment property, commercial investment property, hasn't got much appetite with the high street lenders. That's not necessarily a bad thing, but you normally think of a high street lender as being the one who's going to come to you with the best deals. They don't at the moment. There are a few exceptions. If it's a nice big trading estate with multiple tenants spreading the risk, you might get a nibble at that, but for a lot of the stuff, the high street is not the place to go. So in terms of loan amounts, well, we're looking from 50,000 up to multi-million. So small loans are still available. The sweet spot, probably £250,000 upwards, because below 250 there are less lenders in the game, therefore there's less choice, therefore you probably won't get such good deals. But we've got the whole range. And in terms of rates, well, at the moment, what have I seen recently? 2.7 plus base for an investment property. That's a decent deal. So base rate trackers are still pretty good, still pretty competitive, not far off what you'd get if you're an owner-occupier trying to raise money. And that was from a non-high street bank as well. So 2.7 plus base, I think is really good. However, it's in the fixed rates where things have gone a bit Pete Tong. So with swap rates, which is the long-term cost of finance, being so high at the moment, that's affected the fixed rates that you can get. So a month or two ago, we'd have been talking about rates of maybe 5.6, maybe 6%, fixed for 5 years. In many cases, those lenders have moved up to 8.5%. Now, base rate hasn't moved up that much, but the difference is now massive between a tracker and a fixed rate. So we have to look at all of that to see, whereas previously you might have said, let's go on to a fixed rate. You might not be thinking, well, you know what, I'll take my chances on a tracker because the fixed rates are so high. So yeah, but we're still seeing fixed rates from 6.5, 6.6 upwards on good quality commercial investment property. If it's a bit quirky, then you can be expecting fixed rates from 6.5% up to possibly over 9%. So that's the range. Semi-commercial properties, well, that's a little bit better because there are some better rates on semi-commercial properties around, and you can often get a discount of around about 1% if it's semi-commercial. By semi-commercial, I mean a commercial property downstairs and residential above. Generally speaking, you want the residential element to be more than 50% of the whole, and generally speaking, you want it to have its own separate access. But there are better deals around for semi-commercial. So let's talk about affordability now, because that's really been impacted by the rates available. So with rates going up, especially the fixed rates, that has an impact on the repayments on the loan, which then has an impact on how much you can borrow, especially if it's a little bit tight. So somebody wanting 75% loan to value on a property which is only yielding 5 or 6% could be a little bit tough if your borrowing is at 7%. And the reason for that is that lenders don't just work on the monthly repayment that you are paying. Some of the more high streety type lenders, they're going to take the repayment on the loan, and let's say it's a capital interest loan over 20 years, they'll say, right, your repayment's £1,000 a month. Let's assume rates are going to go up. We'll call it £1,400 a month. Now let's assume that you've got some void periods or something goes wrong. Let's call it £2,000 a month. So you need £2,000 a month to afford that £1,000 repayment. Whereas the interest-only guys and the specialist lenders might say, well, I'll tell you what, you can have it interest-only, so it won't be £1,000 a month. Because you're only paying interest-only, it'll be £600 a month. And we're not going to apply such a high rate because we're a high stress rate because we've already stressed it or we're fixed. So they might say, well, it's 600, call it 850. And in terms of their safety factor, the buffer that they want, where the high street might apply 175%, the specialist might say, well, 125 to 145%. So it means that you can borrow an awful lot more with a high street, with a specialist lender on an interest-only basis than you can on a more bank-type lender over a capital repayment basis. So we can still get up to 75%, and we can still get it at decent repayments on an interest-only basis. But the chances are the rates are going to be higher than you would have been looking at 2, 3, 4, 5 months ago. The key thing here is we need to know everything about the property and we need to know everything about you, so we can put together a proposal to go to the most suitable lender. And the reason you're important is that, you know, the high street lenders are going to be looking for the best property, the best affordability and the best experience, whereas the quirky lenders, the more specialist lenders, might take a view on some of those things, on the type of property, on your experience. It can be difficult if you're coming in and say, I want to buy a commercial property as an investment and I've got no investment experience. A lot of lenders are going to say, we'd like you to get a bit of experience first, please. Where do you go? You're going to go to the buy-to-let market. But if you're an experienced buy-to-let investor and you've got some track record behind you and you can show that, then it gives you more options. So experience is important, property type is important, the yield is important, the lease is important. If you come to us and say, right, I've got a property here and all the tenants are on holdover, versus I've got a property here and everybody's on a 5-year lease with no exits for the tenant, totally different game. So the more high streety bank lenders like to see long-term leases, whereas the specialists will look at something a little bit less. They'll even look at something like going in with a new lease on completion, so you're creating a new lease at that point. There's lots of options. The market is still really strong, and I think there's some opportunities out there as well, because some investors are pausing and going, where's this all going to go? They may well lose out because other investors are going in and saying, well, I'll buy it off you now and I'll buy it off a discount because some people want to sell now. So there's opportunity out there. I guess in closing, I would say preparation is important, but there's only so much you can do. The property is what it is. You are what you are. Your experience is what it is. Your credit history is what it is. So whether you're buying in a limited company or personally, don't get too hung up on that. What we have to do is we have to get into the guts of what's the deal, and whether or not it stacks up on its own, because most lenders are going to say, look, this needs to stack up on affordability in its own right, and we're going to apply stressed interest rates, and we're going to apply debt service coverage factors to make sure we're safe. They vary by lender. Very few lenders are going to say, well, it's okay, you've got a good job and we'll use some of your income to support it. That's called top slicing. There aren't many lenders that do that. Some will do it to a degree. Some will rely totally on that outside income. So you could go and buy a commercial property, it's got no rent on it at all. But if you've got outside income, that's fine. But those lenders, again, we're talking more specialists, you're talking higher rates, lower LTVs, etc. So, listen, I hope that's a good update for you of what's going on in the industry right now. There's still lots of choice, but we have to manipulate, that's the wrong word, we have to make everything look as good as it possibly can, so that when we present it to a lender, they go yes, rather than they say we don't like it. So, pick up the phone or go to www.promisemoney.co.uk. Talk to you soon. Thanks. Bye-bye.